An investor named Mark pulls up a financial news site. The headline reads, "BDC Armageddon, widespread dividend cuts incoming." He reads it, panics a little, and moves his money out of the sector entirely. Exactly 3 weeks later, one specific BDC in that exact sector releases preliminary earnings showing its total investment income jumped from $56.9 million to over $61 million in a single quarter. They maintained their supplemental dividend, their net asset value grew, and they're still yielding around 11% annually. Mark missed it. Now here's the part that's really worth understanding, because this isn't just a story about one stock, it's about a pattern that plays out every time interest rates start falling. I'm gonna walk you through that pattern today, and more importantly, I'm gonna show you the one company that's currently bucking the narrative everyone in financial media keeps pushing. And the numbers, when you look at them closely, are actually pretty surprising. Here's what we're covering: why the fear around this specific sector has been partially overblown, what a well-managed company in that space actually looks like right now, with real numbers, and what the risks still are, because they are real, and you need to know them. Over the past several months, the Federal Reserve cut rates 3 times. 3 consecutive 25 basis point cuts in September, October, and December of 2025, bringing the federal funds rate down to a range of 3.50% to 3.75%. And as of now, in 2026, the Fed has held rates steady at every meeting since. Now, for most types of income investments, falling rates are good news. More people borrow, businesses expand, credit spreads tighten. But there is one category of income investment that feels rate cuts differently and almost immediately: business development companies, BDCs. Here's why. BDCs make their money by lending to small and mid-sized businesses, and unlike most banks, they hold almost entirely floating rate loans in their portfolios. That means the interest income they collect isn't fixed, it moves with the benchmark rate. When rates go down, their income goes down with it, and less income means less available to pay shareholders in dividends. So what you've been seeing in the financial media is exactly what you'd expect. Articles about BDC dividend cuts, stress on payouts, warnings about widespread damage, and look, some of that is real. Monroe Capital recently slashed their dividend, Goldman Sachs BDC went through a cut, FSKRR announced they're evaluating their dividend, which in BDC language almost always means a cut is coming. So the stress exists, I don't want to pretend it doesn't. But here's what most people miss when they read these stories. They treat every BDC like it's the same company. They're not even close. About halfway through last month, one BDC released preliminary earnings results that genuinely surprised people. And the surprise wasn't bad news, it was actually the opposite. The ticker is CSWC. The company is Capital Southwest, an internally managed business development company based in Dallas, Texas, focused on middle market lending. I want to walk you through the actual numbers from their preliminary release, because this is where the story gets interesting. Their preliminary estimate for Q3 2026, that's the quarter ended December 31st, 2025, projected pre-tax net investment income between 59 cents and 60 cents per share, and total GAAP net investment income between 63 cents and 64 cents per share. The actual results came in at 60 cents pre-tax NII and 64 cents GAAP NII, right at the top of their own estimates. Now, why does that matter? Because their total investment income for the quarter came in at $61.45 million, up from $56.9 million the prior quarter. That's an increase of over 8% quarter over quarter in a falling rate environment, with an investment portfolio that is 96.6% floating rate debt. That's the number that should stop you in your tracks. Here's the thing most of the doom and gloom articles skip completely. BDCs don't just sit on their portfolios and watch income shrink when rates fall. The well-managed ones get to work. Think about it from the borrower's side. When the Fed cuts rates, debt becomes cheaper. More businesses go looking for loans. Demand for BDC services actually increases, and a well-run company uses that demand surge to grow its loan book, putting significantly more money to work at slightly lower rates, but doing more of it. Capital Southwest's portfolio grew to $2 billion this quarter, up from $1.9 billion, and expanded to 132 portfolio companies, up from 126 the prior quarter. They originated $244 million in new investments during the quarter alone. That's not passive management, that's active positioning. And the result is that total investment income grew even as the per loan rate ticked down. It's not a perfect defense. At some point, rate cuts deep enough will overwhelm new volume, but for now, it's working. Let's talk about what Capital Southwest is paying, because this is why income investors own it. Back in July 2025, the company switched from quarterly to monthly dividend payments. Their monthly regular dividend is $0.1934 per share. 3 of those per quarter adds up to $0.58 per share quarterly. On top of that, every quarter they pay a supplemental dividend, currently $0.06 per share, bringing the total quarterly payout to $0.64 per share. They didn't reduce the regular dividend when they switched to monthly payments. They didn't cut the supplemental. They actually increased the supplemental from $0.05 to $0.06 starting this year. That's not what a company under severe dividend stress looks like. At current prices, around $23 per share, the total annualized dividend puts the yield at approximately 11%. Now, I want to be clear. Some financial sites will show you a different number depending on whether they include the supplemental. Always look at total distributions, not just the base dividend. In terms of coverage, their pre-tax NNI of $0.60 per share covers the regular dividend of $0.58 at about 103%, and their GAAP NNI of $0.64 per share exactly matches the total payout of $0.64. That's not a huge cushion on the total payout, but it's not deteriorating either. The important context is that they also carry $1.02 per share in undistributed taxable income as a buffer. That's excess earnings they've retained that can support dividends if a quarter comes in softer. And the other metric worth tracking, net asset value. Their NAV per share rose to $16.75, up from $16.62 the prior quarter. In a falling rate environment, NAV tends to get pressured. The fact that it's growing is a signal about portfolio quality. Now, I want to be straight with you, because this isn't a perfect stock, and I don't want you walking away thinking it is. First, Capital Southwest trades at a significant premium to book value. At roughly $23 per share against an NAV of $16.75, you're paying about 1.38 times book. That's a real premium. It's in the same category as Main Street Capital and 6th Street Specialty Lending, companies where the market is simply willing to pay up for quality management. Whether that premium is worth it to you is a personal decision based on your income goals and risk tolerance, but you should know it going in. Second, and this is the bigger macro risk, the Fed is now on hold. The 3 cuts from 2025 are done. Jerome Powell's chairmanship ends in May, and Kevin Warsh has been nominated as the next Fed chair. Warsh has sounded somewhat dovish on rates, but he's still one vote on the committee, and the current environment, with inflation still sticky and oil prices elevated, makes additional cuts far from certain. In fact, as of the April 2026 meeting, the market is pricing in essentially no rate cuts for the remainder of this year. That's actually good news for BDCs relative to the aggressive cuts fear that was circulating at the start of the year. A Fed that pauses gives companies like Capital Southwest time to continue deploying capital without watching their loan income erode further. But, and this is important, if conditions change and rates do get cut aggressively, the math gets harder. Dividend coverage that's tight today gets tighter fast. More cuts could come from higher quality companies, not just the poorly managed ones. Here's something worth keeping in mind if you're an income investor sitting on BDC positions right now. Rates weren't always this high. For the 5 years before the rate hiking cycle began, BDCs were paying lower dividends, and people still owned them, collected income, and did fine. If a company like Capital Southwest were to cut its dividend by, say, 15 or 20% in a much more aggressive cut scenario, all that does is reset the payout roughly to where it was before rates started rising. The underlying business isn't broken, and when rates eventually move back up, and historically they always do, these companies are positioned to raise dividends again. So if you hold a high-quality BDC with strong management history and they go through a minor cut, I genuinely think twice before immediately selling everything. That's not advice, that's just a framework for not making Mark's mistake of reacting to a headline instead of the actual data. Capital Southwest is doing what a well-run BDC should do when rates fall, growing its loan book, maintaining income, protecting its NAV, and continuing to pay shareholders. Total investment income up over 8% quarter over quarter, NAV up to $16.75, supplemental dividend maintained and intact, GAAP NNI covering the total payout dollar for dollar.